course, you guys talk about this all the time. People want legacy, but the government, they want their percentage. Welcome, everybody, to Retirement Compass Radio Show with Stonebridge Wealth Systems. I have Tim Kulhanek in the Lincoln office and Jeff Gove sitting beautifully in it. That's a very nice shirt. You look very frosty and very ready for fall, Mr. Gove, in the Kearney office. And I'm Jackie Selby. How are you both?
Doing good.
Good.
Good, thank you.
Good. I'm glad we're all good. Let's talk about the Secure Act 2.0 and our paradigm shift coming January 1st, 2026, on these catch-up contributions. First of all, do you think this applies to very many people listening to the show today or watching the show on YouTube?
Yes.
Okay, great. I do too, but
Probably
so let's
a lot
talk
of them, actually.
Let's
like
talk
a huge
about it.
percentage of them, I would say.
Oh, good to know.
My kids don't listen to the show, just in case you're wondering.
They don't. They're just too little.
They're a little,
Mine
little
do.
too little.
They like to, set the alarm and make sure they don't miss one.
Don't miss it.
Don't miss Dad on the radio.
Yeah.
That's
So I like to
cute.
talk about them every once in a while.
I know. Oh, is that why? Because they want to know what you're saying about them.
Yep.
Yeah. Everybody's good, though, right? All children well, all wives well. Everybody's good in the company, so on and so forth.
Yeah, I think everybody's good.
My kids, they're going to turn into pumpkins because they've been to every pumpkin patch in a 4-county area.
Oh, my gosh. How many do you have on the front porch?
Thankfully, there's been some restraint shown in that, territory where if they were buying pumpkins, I'm pretty sure you wouldn't see our house. There'd be just a pile of pumpkins over the roof.
I've seen a
Think
couple of
the
these
pies you could
online.
make, though.
Yeah.
The pies, the pumpkin seeds or whatever.
Yeah,
Oh.
think of that. There'd be something going on there.
There would be. That'd be
I'll
quite
give
the
them to
harvest.
Addie, to Zach's fiance, the one that makes the cookies here in the Lincoln office. See, I'm giving her a shout out.
Shout
So we
out.
should maybe get a discount on these cookie situations. But she's very good at confectionery.
Are the cookies the big kind with all the frosting and just one bite is satisfactory?
No, they're walnut chocolate chip, I think is what it is, right? It's the recipe from the Doubletree Hotel. She does a phenomenal job. She's really good at it.
Wonderful.
She makes
Well,
it. It's from scratch, so
We
it
got to
ain't
shout
no
out.
store-bought stuff.
Yeah, we just got to keep Scott out of the fridge or the freezer there.
Seriously, yeah,
He likes to eat all the dough.
Oh, you guys cook them up for clients. I see. You bake them
Yeah,
up?
I've got a
Nice.
little convection oven here.
Hey.
Yeah,
Come in
it's
for
great.
cookies.
Come in for cookies. Stay for the good company.
Coffee and cookies available at Stonebridge. So who gets hit by this new paradigm shifting rule from Secure Act 2.0, Tim?
People that make too much money. No, I'm just kidding. It's one of those things where the government there's been this Rothification of retirement where they're trying to shift more and more people toward kind of nudging them towards making Roth contributions. And the reason being is because they need money now. And so we saw this with Secure 1 and 2.0. There was this massive shift to Roth where they said, hey, you know what? We're going to allow you to do Roth, not just IRA, not just 401k. We're going to allow you to do Roth simple IRAs, Roth SEP IRAs. We're going to allow you to take money that was locked up in a 529 plan and put that into a Roth IRA for the owner. Now, there's another provision that hits. This has been delayed for a few years, hits next year. And it says the rule applies to employees age 50 plus whose FICA wages. So in other words, they're going to look at your like box 5 or whatever. It doesn't count that, I put a bunch of money in the 401k, so therefore I'm below this amount. They're looking at your like Social Security taxable wages. The question is, like, are people, the people we're working with, are they currently making catch-up contributions? And I'd say most of them are. That's something we coach them on. Well, if they are, they're going to be forced to make those catch-up contributions to Roth. The other thing is, will their plans support that? Well, this is where the IRS and the kind of plan providers, there was a little bit of loggerhead type of situation. They said, how are we going to offer this? Are you going to force employers to offer a Roth? And essentially the IRS said, no, we're not going to force them to offer a Roth. We're just going to tell them if they want to allow catch-up contributions to their employees, this has to go to Roth. So no, you don't have to offer the Roth, but either you're going to tell all your employees that are 50 plus, no more catch-up contributions because we can't offer it unless it goes to Roth for the people who are 50 plus who are making these catch-up contributions, or we're going to add a Roth option. So whether you like it or not, Roth is in vogue. It's here to stay, and there's going to be more and more money flowing to Roth, which means more money is taxed in the current year because you get less of a deduction going forward.
That's a bit of a squeeze play, isn't it, that the government put on the employer?
Yeah, I mean, it's one of those things where they said, we're not forcing you. Come on.
Or anything.
Let's not get too excited about this. It's just that if you don't do it, we're going to come after you.
Then the people can't have catch-ups. All right, 866-295-5146. Call Stonebridge Wealth Systems. Get on the schedule, sit down and find out about your catch-up contributions and see if you're becoming Rothified. What did you say earlier? It's the Rothification of America.
Yeah, David Lee Roth.
All right. This is good stuff. Again, on the number for Stonebridge, 866-295-5146. And Mr. Gove, maybe this is the time that we give out the new number because we have a Social Security report that's available via text, right?
Yeah.
Okay, so you can text this number, 308-270-4635, to get your Social Security report from Stonebridge. It's 308-270-4635. And what will they see on this report? And will this link them back to your calendar so they can come in to see you?
Yeah, it will. It'll give them just kind of a general overview of how Social Security works and some of your different claiming strategies that might be available to you, because they're like, we always talk about there's so many different options and everybody's situation is different. And if you don't make the right decision, you could be leaving thousands of dollars on the table, tens of thousands of dollars on the table. So, but it is important, if you text that number, text Social Security to that number.
Okay.
And then it will send you the report via text.
Great. Text Social Security to 308-270-4635. Text Social Security to 308-270-4635. Very nice. Good. I love new features on the show. That's very good to know. Is there grace period nuance here? Is the IRS going to give any grace period stuff?
From what we have been told, and I'm looking at some of my notes here, is that the IRS's final regulations provide a reasonable good faith interpretation window through 2027 to ease compliance. A lot of this stuff has been pushed back from Secure 1.0 and 2.0 as far as implementation goes. I'll have maybe in the next segment, I'll have some examples of that. But
okay.
A lot of this stuff, it's not necessarily like, can we enforce it? It's can the custodians facilitate it? In other words, like next year, they're supposed to put part of the OB3 or One Big Beautiful Bill Act was the Trump accounts. And those aren't supposed to come out till 2026. Well, now they've said, well, it'll be July 4th, 2026, they'll be available. But think about it. That means all these companies, whether it's a mutual fund company or a big brokerage house, it could be a Fidelity or a Vanguard or a Schwab, they've got to come up with a new application, right, that has all the right boxes to check and information that has to be required. They have to come up with new computer systems to facilitate these new types of accounts with new specific, kind of unique rules, because it's not a UTMA account, it's not a 529 account, it's not an IRA, but it has kind of aspects of all three of those accounts. So this stuff's going to take time, so don't be surprised if it continues to get kind of kick the can down the road situation.
Mm-hmm. So at that time, will you have some catch-up rule preview conversations then with your clients and say, hey, let's get in here and see if you want to do some catch-up work?
I mean, this is ongoing, so this isn't new. Every review we do, we're like, how much are you putting in? What is your match?
Okay.
Let's do kind of a cost-benefit analysis here. Let's do a what-if scenario. What if we switch some of your current contributions from traditional to Roth? What if it was 50-50 instead of 100% pre-tax? What if it was 100% Roth? Let's tweak the plan until we find out what kind of the ideal solution is or combination is of tax savings and Roth contributions. Take this as an example. Let's say somebody had a pretty high income and it pushed them into the 32% tax bracket out of 24. Well, that's an 8% jump. So maybe we put enough money into the pre-tax bucket, if you will, to push them back out of the 32 into 24. So we're saving 32%, so to speak, on all those dollars, because we don't think they'll be at 32% or higher in the future. Now, they might be, and maybe that's a risk we're willing to take. But after we put enough in, let's say they need to put $10,000 in, to get out of the 32% bracket. So they do 10,000 pre-tax. Now we're back into that 24% bracket. We we postponed tax on that, avoided the 32%. In my example, $3,200 of federal tax on that money. And then we shift the rest to Roth. So if, it's this year and like it gets a little fuzzy because of the super catch-up contributions, but if we just say it's the $23,500 and $7,500, we're talking about $31,000. The next $21,000 would go to the Roth in that example. But what happens, and this is really important for the listeners to understand, is this isn't like shooting from the hip. There's not just let's wing it and see how it turns out. And then you get to retirement and we look back and we say, well, we should have done that differently. We're going to kind of give you the results in advance. So we're going to test this stuff up front, look into the future and say, well, what will happen when I'm 65 if I put more money into Roth versus traditional? What will happen when I'm 75 and I've got RMDs? Well, the fact that I use the Roth strategy help alleviate my required minimum distribution, that's what RMD stands for, help alleviate that enough to it'll keep me from going over, maybe into the next tax bracket or paying more for Medicare because of an income-related monthly adjustment amount or having to pay the net investment income tax or paying more for my Social Security or getting phased out of some of these additional contributions or additional deductions like the one that was part of OB3. There's all these different things. It's not just one thing, and that's why it's really important to make sure that you have somebody helping you through this, a guide, if you will, who knows when to take that leap, when to go left, when to go right. And that's exactly what our experienced advisors here at Stonebridge are designed to do for all the folks listening out there.
Use 866-295-5146 and book into the calendar wherever you'd like to be seen, whichever of their offices is convenient for you. 866-295-5146.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
Hey, welcome back to the show. There's kind of some technical things about the new One Big Beautiful Bill Act that's going to affect us here in 2026. Retirement Compass radio show with Stonebridge Wealth Systems. Now, I've got the experts here, and they can, kind of chop this up into some palatable bits. But what's going to happen with the tax brackets then? Do you want to talk about that, Jeff?
Sure. Yeah. So the tax brackets were made permanent. They'll call it as permanent as they can be. They can still be changed, but in this context, it just means it's not going to sunset. The 2017 tax law that Trump put in, those were set to sunset at the end of this year. So tax rates would have went back to what they were back then. So this just locked those in. So now there's a little bit more certainty, at least for the next 3 or 4 years. The next president could, or Congress could also change that. But it does give some planning opportunities because we know what tax rates are going to be. I believe tax rates are going to go up in the future. But, we have a window of opportunity to do some things from a tax perspective. We talk a lot about Roth conversions and things like that. A previous segment, we talked about, putting money in the traditional 401k or the Roth 401k, which is best for me. All of that plays into some of these tax law changes.
That's very good to know that it's locked in and there's a little bit more certainty. Like you said, we thought it was going to be one more year to get these Roth conversions done at this current tax rate, but now it's going to extend. But
yeah.
So what is the perfect time to have some money converted from your regular IRA to a Roth IRA? Is there an age for the participant, Tim?
So I like that you asked this question because what I ask people when they come in, I say, have you had these conversations with your current advisor? Are they talking about Roth conversions? And usually they say yes. Yeah, I've heard. We talked about them. Okay, so your RMDs start in 2 years. Why haven't you done anything? Well, they said that the best time to do a conversion is when the market's down. So we're just kind of waiting for that to happen. Well, I mean, the average bull market runs for like 5 years, I think it is right now. If you go back to World War II, you might be waiting a while. And then you're going to be converting less money than you could have done today, because what if your account by the time the market pulls back is still up 30% from where you're at today? And so it kind of goes back to a Peter Lynch quote from back in the day. He said, far more money has been lost waiting on like a market pullback. I'm not saying verbatim here, than has been lost in. So far more money has been lost waiting for a market correction than has been lost in any market correction that has ever happened. Because people sit on the sideline, I'm going to wait until the market pulls back. That's the exact wrong thing to do. You got to take advantage of the tax code each and every year, because you don't get to roll your unconverted dollars. Oh, I had another 100,000 of runway in the 22% bracket or 24% bracket that I could have used that now I don't have anymore. I don't get to carry that forward and make a bigger bracket the next year because I didn't use all of it. I know it sounds silly saying that, but obviously, of course you can't do that. But that's what people do, is they procrastinate. And now we're in a situation with One Big Beautiful Bill Act that, while it's great, it's going to allow us to do more Roth conversions. It's really complicated. There's so many gives and takebacks. The 22% bracket, for all intents and purposes, does not exist for folks anymore that are 65 plus. It's gone. Because what happens is, once you get in that 22% bracket as a single filer, you get like 5 or 10,000 of income, and then after that, you enter the phase-out range from 75,000 of modified adjusted gross income to 175,000, where for every dollar over that amount you earn, you not only pay 22% on that dollar, but 22% on 6 cents, so $1.06. For a married couple, it's $1.12. Why? Because of the phase-out. And so if I have $10,000 over that amount, that $150, and I pay 22%, that's $2,200. But I also have to pay 22% on another $1,200, which is 12% of the $10,000. So even me just saying this, I can hear myself, folks. I know how confusing it sounds. This is what the government does. They create these, like, hey, we're going to do this as a favor to you, like they did the Secure Act when they said you don't have to take your RMDs until 75. There's always a for every benefit they give you, there's a corresponding kind of pitfall that you could fall into that's going to cost you much more money. Because effectively what that means now is, when you convert in that phase-out zone, your effective marginal rate, which is what we care about, what rate are you paying on the conversion itself?
I see.
Your effective marginal rate is 24.24% or 24.54%, because you're phasing out. You're not really paying 22% at all anymore, at least for the next 4 years, 25, 6, 7, and 8. And then at such time, going into 2029, they say that it's going to go back to, they're going to do away with this additional 65 plus, but who knows? Like, look what they're doing right now in Congress, right? They're trying to, they're arguing over this tax health credits, right? The healthcare premium tax credits, right? And they're saying, they're trying to take away, the subsidies. Well, no, what they're doing is they're trying to let the additional COVID-era subsidies expire and go back to the way that the ACA was designed back in 2009, 2010, which at the time said, once your income for, let's just say, a 2-person household, you're 62 years old and you retired early, so you got to have health insurance. You didn't wait until Medicare age, so you're on the ACA, Affordable Care Act is what it's called. Well, what happens is, if your income is above 400% of the federal poverty level, which is around like $21,000, $22,000 right now for a 2-person household. So you take that times 4 and you're like 83,000. Well, if your income's over 83,000, now you're not eligible for like any subsidy whatsoever. So right now, if you can see me on the podcast, if this is zero income, until you get to a certain threshold, you get no subsidy, because the government says you're going to be on Medicaid. You don't qualify for ACA. You don't make enough money. You're Medicaid. And then all of a sudden, you make enough money, let's say it's that 21,000 just for example, and it shoots up, and you've got this huge subsidy that you're going to be eligible for. And then it slowly kind of drifts down as a sloping downward angle until you get like $300,000 for a 2-person household, and then it fully goes away. Well, what's going to happen is, instead of having this slow downward sloping angle, it's going to go way, just like it was, zero, way up, go down at an angle until it gets to 400% or in that $83,000, and then it falls off a cliff and goes to zero. And if you go over that amount, you got to pay it all back. My point in telling folks this, and this is relevant to the conversation and to why we plan, is because, look, right now, the government's spending more money on debt service, on interest payments, than they are on national defense for the first time in history. Okay? We can see where this is going, right? They're spending more money than they have, and they give all these benefits, and they say they're temporary. And what's the old saying? I can't remember who said it. There's nothing more permanent than a temporary government program, right? So you have to prepare yourself. You can't rely on them. Like Ronald Reagan, right? The four most dangerous words. I'm from the government.
I'm here to help.
And I'm here to help. 7 most dangerous, whatever. We're trying to be kind of that guide. Be like, hey, we can see the writing on the wall. Let us help you because these tax rates are going to have to go up. It's a mathematical almost certainty.
That was a very good explanation. I'm so glad that you talked about the ACA there with my question about Roth converting. 866-295-5146, 866-295-5146, because so many people who do want to retire early are going to want to have some health care until 65. Jeff, and if the subsidy is going to be cut off at $83,000, so that doesn't work out very well because maybe somebody's earning way above that amount.
Yeah, well, it could work out okay, but you better have a plan.
All right.
I mean, because if you look at health insurance is very expensive. We're just adding group health insurance here, and it's very expensive.
Yes.
It's nice of Scott to pay for it.
You did? Zach
What's
did?
that?
I said it's nice of Scott that he's paying for it.
Scott's very
thank you,
generous.
Scott.
If you need anything, just call Scott. The other thing that I wanted to touch on was, if you're listening and, some of those tax brackets Tim was talking about, you're like, that's not me. I'm living on Social Security. I don't even have to file a tax return, but I do have this pile of money in my IRA, but I'm not taking any of it because I don't need it. I'm living on Social Security. We all know required minimum distribution age is coming. So whether that's for you 73 or 75, it's going to put you in a much higher tax bracket. So Tim talked about the 22% tax bracket, that doesn't really exist for you over 65. And I would argue the 12% tax bracket for a lot of you, if you have IRAs, if you're taking income, that doesn't exist for you either. Because when you take money out of that IRA, let's say you had to take out 50, 60,000 out of your IRA, you're paying tax on that, but you're also going to pay tax on your Social Security. Like Tim said, we're looking at effective tax rate. How much tax are you actually paying on those dollars? The bracket doesn't matter. If you looked at the numbers, you might be in the 12% tax bracket. If you're paying 22, 24%, it doesn't really matter what that bracket says. It matters how much tax you're paying. So again, having a plan, if you're on Social Security now and you have IRAs, go to stonebridgetaxbill.com and look at the tax implications of having that IRA. And there are some options that you can take advantage of to pay the tax. You're going to have to pay the tax. Someone is going to pay the tax.
And the phone... Yeah, the phone number also, 866-295-5146, 866-295-5146. I am glad that you've added these extra features, stonebridgetaxbill.com. Of course, that was earlier in the year, but this is the time that you're helping people look at their taxes, right, for going forward for 2026. Stonebridgetaxbill.com. Do you find that this is a less confrontational way? People are less committal. They can just go on there and see that the facts are right there and, maybe I should then talk to a professional because I see where this is going with my RMDs.
Well, it's not even just that. Part of our goal as a company is to educate the public.
Right.
So this is an easy way. It takes you 2 minutes to put your stuff in there.
Okay.
Your information, how much you have in IRAs, and it's going to give you good information that you can use.
Great. And you don't have to deposit a bunch of quarters into the machine to get the report to come out. So that's a good thing. All right. No obligation, in other words, is what I'm trying to say. Again, that is an easy thing to do. It's stonebridgetaxbill.com, or call to build an appointment into one of the calendars of the experienced team. 866-295-5146, 866-295-5146. And you're listening to Retirement Compass Radio Show.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Social Security always a big part of planning for your retirement, and that's why Stonebridge has one of the points on the compass being your Social Security plan. You're listening to Retirement Compass Radio Show with Stonebridge. I am right about that, right, with Stonebridge Wealth Systems?
I mean, it's the income plan. So your Social Security strategy is part of an income plan, but it has to be built out around kind of the nucleus of the plan is going to be, hey, I'm retired, my income stops, my paycheck stop, but my expenses don't. And so, yeah, how are we going to draw Social Security? Are we going to maximize it by waiting till 70? Is that truly maximizing it? If we wait till 70, how do we bridge the gap? So yeah, it's a big portion of, an often overlooked portion, right, of a retirement plan, a well thought out, balanced, comprehensive approach to retirement. It has to include optimizing Social Security, not for husband or wife, or it has to be for the whole household, right, for both spouses.
So it's really important, right, Jeff? Because if somebody wants to just take it at 62 and then 65, well, then that is not a well thought out plan because it impacts the rest of your income plan.
Yeah, just drawing it at 62 as opposed to 65. Yeah, we do workshops on Social Security quite a bit across the state of Nebraska. And this is one common theme is, I'm going to take it when I can get it. And people may be working still and don't realize that if you take it at 62, there's income limits where they're basically going to take it all back from you depending on how much you make. On top of that, you're making a decision for the rest of your life. So you draw it at 62, you took a big reduction, and it's for the rest of your life. So that better be well thought out. And we can run calculations based on how long you think you're going to live. And tell you if you draw at this age, this is how much you would get over your lifetime. If you draw at this age, this is how much you get over your lifetime. The other things to consider is, if you're married, in the event of death, either of your death, it doesn't matter who dies, you get the higher of the two. So getting one to be higher could make a lot of sense. But when you look at how much you would receive over your lifetime, for most people, for a lot of people, it's their biggest asset. So why would we make a decision just based on a whim or, I'm just going to take it when I can get it when it's your biggest, most valuable asset that you have for your future?
Regarding Social Security, it's not just the dollar amount you receive. We say this all the time. It's not what you earn. It's what you keep. Go ahead, Jackie.
Keep.
Yeah, Jackie. Good. You've been listening. You've been learning. You could do this show without us. So it's what you keep. That's what we care about. That's my job. And so I pulled up, Jeff mentioned that we do these Social Security workshops. So I pulled up one of our slides that we've designed on there. And essentially it has two different scenarios. Let's assume for a moment that we've got two different couples, married couples. So they're married filing jointly, and they have made the decision on Social Security. And one of them took the approach, I'm going to take it while I can get it. And the other one took the approach that I'm going to use a bridge strategy, and I'm going to use maybe some other resources. Maybe I'm living on capital gains or a brokerage account or something like that. And I might live on that for between 60, let's say I retire at 65, between 65 and 70. For 5 years, I'll just live on capital gains. As long as it's below 120-some thousand, I'm going to pay zero in taxes because I'm going to remain in the roughly 12% bracket, which means long-term gains hit home at zero. It's a wonderful strategy. So one couple, they bring in $45,000 combined from Social Security, but they need $100,000 of total income. So they take $55,000 from their IRAs. So 55 and 45 gets us the 100. Well, Social Security uses something called provisional income to determine how much tax you pay on your Social Security, or put a better way, how much of your Social Security becomes taxable on line 5B. And what they do is they take half your Social Security benefit plus everything else. So in my example, they take half your $45,000 plus all of your $55,000. And then what they do is they come up with what they call their provisional income, which in this example is $77,500. Now, I'm not going to go through all the math, but what happens with this couple, after they apply the two different brackets, because with provisional income, there's, for married couples filing jointly, it's once your provisional income is above $32,000, it's taxed up to 50%, or 50% of your benefit becomes taxable. And then once it's above $44,000, up to 85% of the benefit becomes taxable. For couple number one, their total Social Security benefit, that $45,000 they received, the taxable amount is $34,475. So 77% of their Social Security gets drug off of line 5A onto line 5B. It was supposed to be tax-free. You told me when it went in it was going to be tax-free. You changed the rules in the middle of the game, and now I'm paying tax on 77%, income tax on 77% of my Social Security. Now, some of our friends out there are listening. They're like, no, wait a minute, Tim. State of Nebraska doesn't tax my Social Security anymore. That's true. The feds still do. And that has not changed as part of One Big Beautiful Bill Act. That was, I don't want to call it misinformation, just misunderstanding. There's an additional senior deduction, but they did not change the way that Social Security is taxed. Now, let's look at couple number 2. They delayed. They used that bridge strategy I told you about, which that's something we help folks implement here at our office with our experienced advisors. We've done that for a lot of folks across the state. Okay, so they have $75,000 coming in from Social Security. They only need $25,000 to come in from their retirement accounts, from their IRAs. So we take half their Social Security, we add the $25,000 of IRA withdrawals, and we come up with $62,500 as their provisional income. We apply the tables, the brackets, we do the math. $21,725 of their $75,000 Social Security benefit becomes taxable. They're now paying tax on 29%. So does it matter? It absolutely matters. If you get to keep more of your money in your pocket and keep it out of Washington because you just use a better approach to something as simple as Social Security, which is an oxymoron in and of itself because the Social Security handbook contains roughly 2,728 rules or provisions that outline all the different, gives and takebacks and strategies you could potentially use in claiming your benefit and ongoing maintenance of it. It's actually a really complex type of a complex law, but it's something that every single one of the experienced advisors here at Stonebridge has gone through a certification process to learn more about Social Security through the only accredited Social Security training accredited program in the country to make sure we get this right. Because if it's up to me, if I can keep an extra 40% of your benefit from becoming taxable on your 1040, I need to make sure I'm doing everything to achieve that for you so you're going to have a more higher satisfaction and more free cash flow, discretionary income in retirement.
Use this number. Get on the books, 866-295-5146. Get yourself registered for a free sit-down with one of the experienced advisors at Stonebridge Wealth Systems, 866-295-5146. I admire you for being able to, all of you, for being able to stay awake during that training and seminar because Social Security is rather dry, those 2,700. It's seriously. All right. What do you know about COLA? I tried to ask you that earlier. Do you think that there's either of you, have you heard anything about a COLA? And maybe you could explain why a COLA increase really could be show up on their Social Security check as a slight negative. You get the increase, but then Medicare goes up in cost, yes?
So there's something called the hold harmless rule within Social Security that essentially says you can't get a reduction in benefit because of an increase in your Medicare premium, but that can catch up to you in the sense that your COLAs in the future could then get eaten up by the unincreased amount of your Medicare premium. So yeah, the reality is your COLA could get eaten up by an increase in your Medicare premiums. It's based off of CPIW, the average wage increase for urban wage and clerical workers. I would guess that it's going to be around 2.5 to 2.75% going into 2026. But maybe on a couple weeks from now, we can check my math. But that's what my assumption is. We're looking at 2.5 to 2.75%.
Okay, very good. Whoosh. I'm glad that you did sit through that seminar to learn all the rules about Social Security. Maybe this is also a good time to bring up your new Social Security text code. If you want a Social Security report, text Social Security to this number. Text Social Security to 308-270-4635. 308-270-4635. All of this is available, though, on the website, isn't it? StonebridgeIWM.com. All of this new information, you could go to, that's their landing page, and all the media content, et cetera, is there. But there are some other fun things listed, and we're going to talk about, like StonebridgeLegacy.net. Jeff, we could do that coming up on the show if you'd like to.
Sure.
But again, just to get on the calendar, we have one centralized number, whether you want to see Stonebridge in Kearney, Grand Island, Omaha, or Lincoln. It's 866-295-5146, 866-295-5146, and we'll be right back.
As Americans, we strive for better. from a better house to a better career to a better life for our children and grandchildren. Better has become the American way. When it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better solutions? A better retirement begins with a financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Welcome back to the show. We're so glad to have you spending a little bit of time with us here. Retirement Compass radio show with Stonebridge Wealth Systems. You have something new online, as they say. Something new. It's called StonebridgeLegacy.net. What can we find there?
Yeah, so that's going to just basically run you through a quiz that's going to determine how prepared you are or how prepared your legacy is. Do you have a will? Do you have a trust? Has it been updated? Do you have beneficiaries named on your accounts? A lot of these things that if you don't have things in order, if you don't have a will, I don't think you like. If you live in the state of Nebraska, what they have for you, I don't think you're going to like. For example, if you're married and let's say you have no kids and let's say you're farming and you have a farm, it's just you and your wife and your parents are still alive.
Okay.
If you die intestate, meaning you don't have a will, it's like the first 100,000 goes to your wife and then half goes to your parents and the wife gets the other half. It's something like that. It's something you would never want to happen. It'd make Thanksgiving really uncomfortable for your wife, I think, if you had to give half of your assets to your wife. So have a plan, and you could start there. Go to StonebridgeLegacy.net, go through the quiz, and then it'll give you a kind of a starting point of, where do I go from here?
That's fun. So you do want the legacy part to be done right. And that you're adding these extra tools is just fantastic, I think. StonebridgeLegacy.net. And in previous segments, we were talking about your new Social Security text code for a Social Security report. And that is as easy as texting Social Security. You don't have to have a space between the two words, but if you want to text Social Security to not your Social Security number, just the words Social Security to 308-270-4635. It's a new number, so I'll get used to it. 308-270-4635. So those are two very nice new tools. And we also have StonebridgeRetirement.net.
Mm-hmm. Yeah, StonebridgeRetirement.net, that's like a retirement readiness quiz is what we call it.
Okay.
So, have you checked the boxes that need to be checked for retirement? Are you on the right path to retirement? And it's just going to grade you at the end. And if you need help, you can always click the button that says, I need help based on how I answered these questions. And we'd be happy to help you. But the purpose of these quizzes is we want you to know where you're at and to know if changes need to be made, let's change them.
Right. It's kind of tricky because you don't know until you know that you don't know, if that makes sense. And so I think these are just nice tools to make people just think a little bit about are they prepared? Well,
and I think especially when it comes to taxes and Social Security, because Social Security is really complex. So, if you're a widow or a widower, you have different options than, somebody that's single or is married. There's other really, really good benefits for you that if you don't take advantage of those, you're going to leave a lot of money on the table. So, text Social Security to that number and get the free report. It's free.
Again, it's text the word Social Security to 308-270-4635, 308-270-4635. And that's a nice Social Security report. Gosh, we've talked about so much to do with taxes, Social Security, legacy. I guess it's all part of the plan, isn't it, Jeff?
Yeah. If you leave one of these out, let's say you just focus on your legacy plan, but you don't do any of the other planning, you could put yourself in a position where you don't have a legacy to leave. So all of the work you did on the end, didn't really benefit you because you didn't have a good income plan, or you invested your money in a way that you ended up running out of money, or healthcare plan wasn't in line, so you had to pay more than you needed to for health benefits. All of these things work together. That's why we built the Retirement Compass, was to address all of the things that need to be addressed when you go into retirement.
866-295-5146, 866-295-5146.
Is your retirement being eaten up by financial termites like hidden fees, inflation, and avoidable taxes? Call today for a complimentary financial review so we can help you root out these retirement killers.
Retirement is not just about income, it's about the unexpected costs that come with aging. That's why we're on the radio here. Retirement Compass radio show with Stonebridge. Stonebridge Wealth Systems, 866-295-5146, 866-295-5146. So we have a batch of scenarios. Jeff, you ready to attack?
Let's do it.
All right. If someone's 64 and considering retiring early, not sure how to bridge that health care coverage until Medicare at 65, what options exist to manage healthcare costs without draining the savings before age 65, or do you not recommend it at all? Go ahead and say what you think.
Well, I definitely recommend it, but have a plan.
All right.
So 64, so once you hit 65, you'd be eligible for Medicare. So we just got to get you to 65. So a few options. You could use COBRA. If you have group health insurance through your employer, you can use COBRA, which just maintains that plan. So you stay on your insurance. It's going to be expensive because you're going to pay for the whole benefit. The employer's not going to pay for any more of it, which at that time you'll understand what your employer was doing for you. Like I said earlier, we're starting a group health plan here, and it's expensive. So thank your employer for the group health insurance. But so that would be option number one. Option number two, you could do like a short term, like a temporary health plan where it's if you have pre-existing insurance or pre-existing issues like health issues, this isn't going to be a good option for you because they can exclude you for different things or exclude different illnesses or injuries. So it might not be the best thing. Otherwise, you could go to do Affordable Care Act, the ACA plans. There are options. You may be able to qualify for a subsidy. I have a lot of people that say, I'm not going to retire until 65 because I need health insurance, and which is valid for sure. But there are options, and sometimes with the ACA plans, depending on your income or how much income you're bringing in, you may not pay much for your health insurance. You may be able to get a good subsidy to get you there. So, just make sure you have a plan. Don't retire at 64 and then come in and say, I got to figure out health insurance, because it does take a little bit of time.
And it'll be expensive if you do it that way.
It could be, yes.
As you mentioned, the COBRA payments. If you've ever had to pay COBRA, it's like a knife to the heart every check you write.
Yeah.
It really is. All right. Very good. Very good. Stonebridge available to speak to you at 866-295-5146, 866-295-5146. Anytime you can place that call and then get on the calendar, and many options for location as well. Kearney is what I'm trying to say, the Grand Island office. There's Lincoln, there's Omaha, and they'd be happy to come to you, or you could do a virtual appointment the first time. They're pretty flexible. But Jeremy Gove, Jeff's brother, he's got a lot of miles on those tires, and he'll run around and meet you wherever you need to be seen. 866-295-5146. Even up dirt roads. I know he has, hasn't he?
He has.
Yeah.
Don't trust the GPS in the country.
No. No. I've learned that the hard way. There you are, sitting in the middle of a cornfield. Where is everyone? All right, here's another situation. These folks own their home outright, worth about $350,000 to $370,000, and they're considering a reverse mortgage to supplement their income. Now, do you talk to people about this? What are the key risks and benefits if somebody is weighing this before tapping into home equity? I mean, there's other ways to tap into it other than just a reverse mortgage. Am I right?
Yeah, there is. And I guess just to start this conversation off, there's one time since I've started in the financial services industry in 2008 that a guy came to me and was like, I want to do a reverse mortgage, and where I said, I think it's a good idea for you. It's one time.
Just one time, was it a good idea? All right.
And the reason for that was, for him, was he was an elderly gentleman, not in great health, very low income. I think his Social Security was $950 a month. He had used up all his retirement accounts, so he didn't have any other money coming in. He did own his home outright. He didn't have any children. So it was a way for him to access the equity in that house because he wasn't leaving that to anyone anyway. He accessed the equity in that house to supplement his income so he could eat, so he could pay. Well, he wasn't paying property taxes. He was getting homestead exemption, but just to pay the expenses, pay your utilities, those things, because things were really tight. So I would say it's the last thing that you would want to do. We'd go through all the other options before you do that.
Right. But there's no shame in it for
Nope.
certain. Sometimes people, that is the asset that they have protected all this time. Mm-hmm. And if you need to use it, you need to use it. 866-295-5146, 866-295-5146. All right, how about dental charges? Somebody hit with a high dental bill, realize that Medicare doesn't cover much of your dental coverage. Again, I guess what you're going to say, this comes down to a plan, but what are some of the overlooked healthcare costs retirees should plan for?
Well, that's a big one. Dental, vision, your eyeglasses, those types of things. If you don't buy a dental and vision plan, which you can, you're going to pay for that stuff out of pocket because Medicare doesn't cover that unless it's like medically necessary care, like glaucoma or, some people get eye injections for different things. But, those are a couple of the big ones. We talked about a $5,000 dental bill. What if you had a $15,000 nursing home bill? Because, you went into it thinking, I have Medicare. Medicare covers long-term care. It does not cover long-term care. So that would be a really shocking surprise, for your loved ones to have to start paying that out. That can eat into a nest egg really quickly. So those are a few. One more would be prescription drugs, depending on what drugs you take, which we're right in the middle of that time period where you should be shopping your drug plan. So if you're on Medicare and you don't shop your drug plan every year, you need to do that because, and this is something I feel like they need to change, even if your prescriptions don't change, the plan that you're on from the previous year can change how it covers those prescriptions from year to year. So my grandmother, for example, she's 95 years old this year, still lives at home. She's fiery. She's great. But what comes along with that fieriness is a little bit of stubbornness. Mm-hmm. And there was one year she said, my prescriptions haven't changed. I'm not changing anything. I don't need to shop it. Oh. So she didn't. And she's on a fixed income. She's living on Social Security. So January came around. Now it's too late to make a change because she had that window where she could do it, which I think is October 15th to December 7th. Mm-hmm. And she started paying more for her prescriptions. And it was like $100 a month more for her prescriptions, which when you're living on Social Security alone, that's a big deal. So she learned a hard lesson that year. Mm-hmm. We were able to help her out, but she did learn. So you do need to shop that every year because that can get really expensive too.
Boy, especially for those on Social Security, this could be detrimental.
Yeah. Yep.
Yeah, to your income. All right. Call Jeff and talk to him about it. Call one of the experienced advisors. First, just use the 866 number to help on the schedule right into the calendar and see which time and place is best for you. 866-295-5146. You still have your Medicare professional on staff, yes?
We do. Ron, who was with us, he's retired.
Oh, good
So
for
now
Roth.
we have Kelly Gideon here in our office.
Oh, great.
She is busy, but if you need help with Medicare, if you're just going on to Medicare or you're on Medicare, you have a supplement that is going up and up and up, give us a call. We'd be happy to get you in and call quickly because the calendar is filling up very, very fast.
Yes, please do. 866-295-5146, 866-295-5146. Okay, what about somebody thinking of relocating to be closer to family, but housing prices are higher in the new area? Should they sell their current home or buy something smaller? Renting? Is this a smart move?
Yeah. I feel like this is the kind of the canned answer, but everybody's situation is different. You probably could have expected that. But I have some clients here in town, in Kearney, that are looking at downsizing. Right now, to do what they want to do, they want to go to a condo. It's going to cost a little bit more than what they have now, even though it's a smaller house, when you add in HOA and things like that.
Oh, golly.
So their house is paid off. So for them, and this is rare, but we recommended that they sell the house and actually rent a place. So it comes with all the same benefits of the yard care, the snow removal, in some cases, the internet and the cable is included. Depending on what you do, maybe the gym is included. There's a lot of different things, but they're paying less in payments, and now they'll have about $450,000 that they can invest and spend income off of that to pay for that. So it actually puts them in a much better position. But that's not always the case.
Okay.
Sometimes it does make sense to, sell the house, go buy a different one, even if it costs a little bit more, depending on what assets you have, to accomplish that goal. So every situation's different.
But it's nice to hear two sides to that story. That's really interesting.
Yeah.
866-295-5146. Call Stonebridge, 866-295-5146. We're getting close to the end of the show. Gosh, Jeff, it's kind of flown by in a way.
It has, yeah. We covered a lot of different topics
We
today.
did. We covered a lot of ground. And you can always hear this show again if you choose to hear it in podcast form anywhere you get your podcasts. And it is called The Retirement Compass. And you can check out the website, stonebridgeiwm.com, for all of these links that we talk about, all right? One more time on the phone number, 866-295-5146.